Welcome to the Treasury Update podcast presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in. On this episode of the 2020 Outlook series, Jeffery talks with Tom Leitch, Vice President and Chief Operating Officer, and McNaughton, Head of Product UK at TreasuryXpress, to discuss how the COVID crisis is reshaping and accelerating regulations and compliance. This wide-range discussion covers the top regulatory challenges with a focus on open banking, KYC solutions, corporate initiatives, LIBOR replacement, the impact of COVID-19, and more. Listen in to find out how rapid changes are driving innovations and how tech must rise to the challenge for the greater good in turbulent times.
Welcome to the Treasury Update podcast. This is Jeffery, the Managing Partner of Strategic Treasurer. I'm joined by two guest speakers from TreasuryXpress, Tom Leitch, who's the Vice President and Chief Operating Officer there, and McNaughton, who's the Head of Product UK, both from TreasuryXpress. Welcome to the podcast, Tom and Ian.
Thank you very much, Craig. It's great to be here today.
Thank you, Greg. It's great to be here today.
All right. I'm going to begin with you, Tom. If we're talking about regulations, maybe we could start with an overview. So maybe you could begin with just listing some of the top regulatory challenges that Treasury and finance is facing, just a macro view to get us started.
Yeah, absolutely. So, we've been talking about the regulatory stuff that's been coming up for some time now. And we've been focused on as a company, as an industry in Europe and in the US, heavily on open banking and the idea of open treasury. Now, that sort of falls into more of the UK with open banking, in Europe with PSD2. But we've seen a number of banks from North America, because of their relationships in Europe, adopting these APIs. So we've seen a sort of huge uptake in the last sort of 3 or 4 months on the knowledge of corporates around the technical possibilities of what the regulatory changes have caused around open banking. Beyond that, we've also seen a lot of changes around how KYC, with the adoption of virtual account management, escrow accounts being used in the industry more and more. And there's some really cool sort of tech that's popping up around that. We're looking also at sort of calculations around interest, looking at the reduction in use of LIBOR, with SONIA coming up, and how corporates need to adopt with that. They've actually pushed it back a little bit, and we hope that due to COVID-19 that it won't go any further back. But we're seeing a lot of banks starting to reduce the amount of LIBOR-linked products being published, and Ian will touch on a bit later about the sort of influence and how that's changing in the market. And we're seeing things sort of, as we've been talking about for years, now coming into effect. So I think corporates in general are coming to us and asking more about how we're addressing issues. Like yesterday, Ian and I had a call with a Belgian company who used to work actually at Deloitte, and he was very well versed in how we're going to look at recalculating issued debt already. So it's very exciting being in a time where everything that's been talked about over the years is now coming to fruition. It's just a bit of a difficult time, obviously, with what's going on, to see will these things have the impact they're intended to, or will they actually hinder corporate adoption and make things more complex for corporates as they move forward?
Sure, Tom, exactly right. So from my perspective, there's a huge transitional process going through on the LIBOR, as we mentioned, with the replacement of LIBOR and the introduction of overnight rates and a backward-looking curve. This is going to have a huge impact on the market. We've also, as you rightly said, with the KYC, we see a lot of banks these days moving into the virtual account management area, which is going to cut down a lot on the KYC and all the rigmarole that goes behind opening bank accounts. Now, this is not a new feature within the Treasury industry, because we've had in-house banking in the systems for years, but now we're seeing at the top level where the banks are offering this to the clients. So really, from a technology perspective, we've got to be able to cater for that and be ready for all these new developments, whereby corporates and smaller companies as well will be using less and less bank accounts, but relying more on their technology partner to run their business.
Thank you for all those items. I think we've laid out quite a few areas from open banking to LIBOR replacement and KYC. As we get into this in a little more depth, I wanted to just mention that maybe we could factor in or bring in some elements of how the pandemic, the COVID-19 crisis or issue is impacting these different areas as we move through that type of environment. Because obviously there's some influence with speed or rapidity or ability to adapt that I think will play a factor here as well. So I wanted to make sure that we're thinking about that as we talk through the different elements. But why don't we begin, and I'll start with you, Tom, again on the open banking, open treasury concept. And you mentioned the PSD2 driving that in the Eurozone. But maybe you could start us there. What's happening there? How is COVID's impact helping or hurting some of the developments there?
Yeah, absolutely. So let's start perhaps with the actual regulatory change, and then we can sort of touch on what it was intended to do and then how it's being affected. So as we all know, I think, as I said before, the number of corporates who are aware of the regulatory requirements for PSD2 and open banking has increased dramatically over the last 6 months. Almost every corporate we speak to, as we're discussing connectivity methods to the banks, which usually in the past occurred through either SWIFT or SFTP to receive information from their banking partners, we're now seeing more and more requests say, can you or have you got a link to the bank through API? Now, this is the idea behind open banking, is the ability for any corporate or any customer of the bank to retrieve data seamlessly from their bank provider. And the benefit, of course, for that is that data is everything, but it's more to the point that corporates can then power other systems with it. We've actually already seen ERPs integrate through API to receive the statements for like reconciliation, for tagging transactions and looking what sort of AR and AP have occurred. But we're now seeing ourselves being asked to actually forefront that and power the ERP behind us. So open banking as a general sort of consensus is a very positive impact. However, as this has become more open and more transparent of what the abilities are right now, we are seeing some shortfalls. Now, we have taken the sort of line of inquiry with our clients and our banks to say, what can actually come through these APIs? Is there any restriction on the data? And most banks agree that there is no restriction on data compared to an MT940 or other file. However, the issue comes on when we're looking at the transmission of this data. For example, if we were to build 2,000 connections, let's say to the 2,000 banks in Europe, that would take us a vast amount of years. So what we've done is we've looked at this from a different approach from what exists in the market already. For example, SWIFT is the multi-bank inter-messaging system, so you can connect to almost any bank in the world through SWIFT. We've actually looked out in the market to see what aggregators there are in place. For example, on Monday this week, Microsoft have partnered with Plaid. Now, Plaid isn't truly only API. They have APIs built to institutions in the US, but they also use technology like screenscaping where they haven't got a direct link. So in Europe, speaking from this side, we have companies which act as these aggregators. So rather than us going 1 to 2,000, what we actually done is 1 to 1. So we're looking at aggregators that have the APIs available to draw the data in. As we've explored this further and further, what we've actually seen is that there is no regulation or stipulation in the regulation, meaning that this is a one-time authentication. What I mean by that is as we dive deeper, we're seeing that corporates have to re-authenticate themselves every 3 months on these APIs. Now, if you have 1 or 2 banks, that is fine, you're the main user of it. However, if you look at the average corporate structure of companies who are using a treasury management system, we're seeing anywhere between, let's say, the low end of 5 banks and the high end of 90 to 100 banks. Now, if you've got to authenticate every bank every 3 months, and you may not be the primary user to do that, it does become extremely complex. Now, obviously, with what's going on with coronavirus, corporates have other things to do. So they are using the bank portal as is, and they're happy. It's their status quo. To go and adopt TMS, you're almost anticipating that this will be done for you. However, due to the regulation, even within the TMS, you're having to be forced to re-authenticate. So it is going to be very difficult to get this through to corporates. So we're looking at other ways of doing it and seeing if we can bypass these authentications somehow, and working with our banking partners to find out more around it. But that's one side of the open banking. I mean, it is, truth be told, a benefit of a TMS. It's untold in these instances of what we're going through, because the ability to work from home and draw data freely whenever you want and as much as you want is the antithesis of running a successful treasury in the times of crisis. So we're seeing a big uptake, surprisingly so, I think, compared to any other market, of people looking for a system to automate these tasks and to give them the data they want. So I think open banking in general is an extremely positive change through regulation. However, I think there are still speed bumps that perhaps we haven't thought about because we're so bedazzled by the fact we can get data for extremely low cost into our systems and provide our customers. So the transition and adoption of these is not going to be as seamless as we had hoped. We've seen the speed bumps that are now occurring, and it certainly won't be the end of it, because even when we just look at the visibility side of bringing in your transactions and balances, we haven't even yet seen the difficulties that come when it comes to payments. Are we going to have to use certain formats that still have the country specifics? Are we going to have to use bank specific formats? Germany are all on the same API, so they have one universal format. But we're only at the very start of this adoption of open banking, and it is going to be a force for change, and it will be positive. But there's certainly, in the pioneer area, which we are in, there is going to be hurdles to be faced. We will always overcome it. And that is why technology, and especially if you're using a forward-thinking technology as a partner, you want them on your side, because you don't want to hit a speed bump and then the whole thing loses traction and then you're back to square one.
Yeah, fair enough, Tom. And maybe I can bring in Ian as well, but just a couple questions there. So one of the speed bumps earlier was there was limitations on how much capacity you could put through there. And as people connected to the banks, they found that they would hit some volume limitations, and then adjustments were made and they overcame them. This, resetting the reauthentication process, is that something that's likely to be solved, do you think, as well, in the, just by working together? Or is there an opportunity for other aggregators who do that reauthentication and then your connection to an aggregator doesn't have to have that? And so, to Ian, and I don't know if you wanted to add to what Tom said or begin by responding, but either one of you can take that.
Sure, I can respond. So what we're finding when Tom and I are going out to these companies and looking at the APIs is not only do you have the re-authentication process every 3 months, the banks at the moment aren't willing to release the data for certain level of corporate accounts at the moment. And also, if you're looking for a real-time solution, all you can do at the moment is download the data 4 times a day, which is not really what a real-time corporate treasury would be looking for. So there's a lot of room for improvement from the regulation side, and it's because it's a new concept as well. It's really got to be open to the corporates, but obviously on the other side, the banks are not wanting to lose the ability to charge their client for the privilege of using their internal banking system. So there's a push and pull between the banking systems and the regulators, but what clients or our clients that we see are entitled to pull for open banking information.
And I think to add on to that, I think you're absolutely right, Ian, that banks are reluctant at the current time to open too much up. And we're seeing this, and we can touch on this later on, some of the difficulties that banks are potentially causing during this crisis, is we've seen huge, let's say from UK, we know the government has now put in place 350 billion or so in funding for companies. However, I saw last night in the news that companies under 45 billion have only been issued 95 million in loans. Now, that's not through lack of trying, it's the paperwork. So banks are sort of pushing back a bit when there have been things instructed upon them. And I think hopefully out of this entire issue we're facing globally now, I feel that we've seen a lot of companies come to the aid of individuals, and I eventually will see that a force for change through sort of unanimous decision for the better will affect this, and we will see banks produce more open infrastructures, and will be compelled to be almost a differentiator, saying, look, others are making it difficult because that's the old way of operating. And these neobanks and other banks will come out and say, hey, look, this is how we should be doing business. This is the open infrastructure we've built ourselves on. We can help you more than the traditional banks. So there's been this huge debate of, are banks becoming fintechs? I don't think so. I think fintechs are becoming banks. Banks are just becoming, polished up ideas of fintechs. But I think we're going to see some real disruption and real chaos caused for the positive from these challenger banks and neobanks.
Yeah, interesting. So let's shift over to KYC. Know your customer, important and a big headache. So maybe Ian, you could start us off with that. I know you'd mentioned some things about virtual account management, but
Sure. So just to follow on from Tom's point with the open banking, so we're also seeing developments in the KYC processes from corporates and banks for opening up their bank accounts. So this is usually a very, very time-consuming process, and there's a lot of room for improvement using the technology sector to get the time to market, or the time you can get your bank account, or indeed any funding requirements from the banks. There's a huge gap in the market of the speed of which you can get all your documents in place, get all the KYC done, and actually deliver the product and start using the bank accounts or start pulling the funding levels. Because it's a real sort of administration nightmare at the moment. But we are seeing some developments, as Tom mentioned earlier, with sort of escrow accounts. Now, the regulations have changed on escrow accounts. So we're seeing technology providers coming into that market and basically blowing the whole KYC usual rigmarole around, the barriers around setting up an escrow account, blowing that out of the water and doing it all on a technology base, which is great, but there's still a lot of improvement to be done.
Are those regulations primarily centered in the UK, or are you seeing those in other countries as well?
So primarily we're seeing them in the UK, so it's all based around holding client money. Because of what's happened in 2008, when there was a lot of client money in the market that was not very liquid. So they're pulling the regulation back of who can hold it and how it can be signed on. But the general structure of escrow accounts has been very, very, very secure, but very, very slow for many, many years. So it's time now with technology to move on. And that is a great example of the way technology can take an old banking method and blow it out of the water. And we're seeing that as well with virtual account management, as we touched on before, where more and more corporates are fed up with waiting 3-4 months for a bank account to be open for their company. So they're coming to us. Some banks do offer it, but they're generally coming to us or the technology sector to say, look, we want one pooled account, but we're going to run 5 companies out of it, which is an old concept. But it's never really been supported properly from both levels, from both the bank level and from the technology level.
Yeah, so providing that extra level of detail. So that is interesting. It fits with the theme of tech rising to the challenge, whether it's tech at the banks or tech in individual companies. I want to move to corporate initiatives for a moment. This is how is that impacting vendors in particular? And we'll start with Tom, but I guess maybe it would be helpful to give a little bit of a background on the concept of corporate initiatives. What are we talking about here? How is that impacting what a typical tech vendor would do to support that?
Yeah, I remember we had this podcast, I think roughly the same time last year, and we were talking about almost the cloud second revolution it was, or second part, where companies now, categorically, unless you're a large government or large entity, want everything hosted on the cloud. So in order for vendors to be at the forefront, we see now everyone being or having their application to SOC 1, SOC 2. We see the ISO 27001, which is all based around security, audit, and calculation methods. So as technology vendors are under more scrutiny, we've been luckily able to sort of as agile fintech companies adopt to this requirement. Corporates have been a little slow, but now they are focused on it. They have the eye of Sauron almost, looking around to see who hasn't got it and immediately removing themselves or their vendor from the process. So corporates, especially now, we've seen, for example, Teams, the Microsoft product, that collapsed when everyone in Europe started working from home mid-March. But because of the sheer volume, we're seeing more and more technology products coming on the market that record your screen for audit purposes to make sure that you're not doing anything undue. We're seeing AI machine learning looking around the focus on security of saying, right, you're normally right-handed. We now detect the fact that you're using a left hand on our system and locking you out. So I think technology and CTOs and InfoSec teams within corporates are now getting heavily involved, especially in the treasury management space, because more and more companies want to take advantage of the payment function of these systems. It's great having visibility, which used to be the driver. It's great having cash positioning. It's great understanding your financial instruments. But what they're now looking at is how we can centralize and control the payments. So, for example, a lot of our customers, since all of this happened and since working from home, they've come to us saying, can you segregate your payment workflow approval into its own system? So even though we do our approvals at the bank, we still want to add another additional layer on our systems and our processes around security to make sure these payments are being approved at the correct level. Because no longer can you walk into an office with a printout and get a wet signature. It would take you weeks to get a letter sent around for review, especially with everything going on. So we're now seeing that through the catalyst that is COVID-19, the requirement to be able to work virtually, to be able to be agile with your processes. And of course, some people will be out sick or tending to other people and won't be able to sign. So you want to be able to have a system in place where you can quickly switch a signer without contacting the bank. As we said at the previous point, to go through KYC or bank account management, the idea was 7 years ago, IBAN would be the best thing since sliced bread. It never came to fruition because, again, the banks wouldn't work together. So what we're seeing is that fintech companies and technology and treasury is coming to the forefront again to override these hurdles. And as I said, it's a catalyst. So things are speeding up massively because everyone is now a remote worker. I think there's 3.5 billion around the world that are now working from home, where before we had probably 4 or 5% of the population were working from home. And that wouldn't be all the time.
Thanks, Tom. Now, Ian, moving over to the LIBOR replacement, or as you may refer to as IBOR replacement, what's going on there? Obviously, we had a little bit of a overview in the beginning with Tom describing some elements of it, and I think you mentioned a few things as well. What's happening, and what's the impact of this regulatory change?
Yeah, so what we're seeing now is there's more and more products coming into the market on a corporate level, but because the interest rate calculation is now backward looking rather than forward looking, the technology has got to rise to the challenge to be able to support that. So we're going to have LIBOR products that are going to run off, and then you're going to start with the new overnight reference rate products, but there's going to be a gap in the middle. Now, at the moment, we've got a little idea of how we're going to cope with that, but it's looking as though you're going to run off with one product, you're going to have a fixed product in the middle, and then you're going to have the transition into the new backward-looking rate. So technology companies have to be on the ball and be able to have that as smooth as possible. Now, the best way of doing that is for the technology providers like us to keep up with the regulation and any updates that come out of the FCA or the Bank of England or the Fed or wherever it is. But also, we've got to make sure we're communicating those updates back to our client base. And also from the client's perspective, they've got to be talking to their banking partners, seeing how they're going to deal with the transition and relate that back to us, because it's all got to work in synergy. It's going to be a really, really catastrophic event if globally LIBOR is removed, but all the different countries are involved in it, which is the whole world, are not working together or coordinated together in timing, then it can have a huge effect on the market. And also, if you've got one country that's behind the others with the transition, then you're going to give rise to arbitrage markets for savvy traders who are going to be trying to make money on the back of it, which is unfair on that global economy. So there's a huge, huge impact to the market. It's probably the biggest one we've seen for the last 10 to 15 years.
Seeing COVID-19 and what organizations, healthcare systems are doing, and then obviously financial regulators, maybe even central banks are weighing in on this, do you think that this is going going to stick with the same timetable? You think there'll be some other adjustments to it?
Yeah, so here in the UK, we've the FCA have told us that at the end of Q3, then no more LIBOR-related products will be offered to the market, so even on a corporate level. But because of obviously this black swan event with COVID-19, then I think the regulators have got to act responsibly, and you'll probably see a push out of that cutoff time. So LIBOR is supposed to disappear by the end of 2021. That might still hold firm, but the actual transition of when the banks are going to be actually offering these new products may be pushed back.
I want to shift over to a couple other concepts here. One is regulation and compliance activities can drive innovation. To respond to those, innovation can also make things better or help address some of the speed bumps that you talked about, Tom. But maybe the question is, maybe first to you, Tom, is how does tech have to rise to the challenge of the regulations? There's regulations that add complexity, and these changes happen quickly over a relatively short period of time. So how does and what does tech need to do to address these?
Technology needs to, it's a difficult one, because with what we're doing at the moment, we can have an understanding of where the end point is. But being a tech company ourselves, albeit a small one versus a big one, each size has its own difficulties, because of course the big ones can influence more on what's going around the regulation and how it should be adopted and how they think it's going. So I think both parties need to be able to be very agile with adopting and moving with shifting timeframes or shifting events. Ian has correctly pointed out we are in a black swan period where we don't know what's going on really. And I think we're only at the very beginning of it. So I think as our company, we're focused on addressing everything we can at a 75% level, and then waiting to see where it adjusts. Because what you don't want to do is build something 100%, and then as things change, that becomes redundant. So I think a lot of tech companies are sort of going for not really a scattergun approach, but a logical methodology of saying, this is the core focus. Let's build parameters either side that will allow us to change it. So keeping an open infrastructure on design, which means we can change it. So for example, we've developed a new loan module with the idea this is coming into effect, as Ian pointed out, on those dates. But what we've also done is make the system able to adapt to anything else that happens in the future. I mean, we've started seeing the market with everything going around climate change, like green bond issuance and green linked products. But I don't think we're going down that route. I think we're going to see a lot of more functionality around corporates, even the small ones needing these debt products, and maybe tracking them quicker and easier. So I think the most important thing from a tech side when it comes to regulation is, yes, adhere to it. But because we are in this period of excessive sort of change and things literally changing overnight, we have to be firmly able to stop something and restart it, not from the beginning, but from halfway down the development cycle to then change and adhere to the new process.
I like that stop and start. I mean, there's looking at some different forms that have been coming out the last couple of days. They're changing every few hours as things are developing very rapidly from a regulatory standpoint, not directly impacting Treasury per se, but we're seeing that across the board, and that adaptability seems very, very well taken. Ian, did you have anything else you wanted to mention in terms of tech's response to that?
Yeah, sure. I mean, innovation is always driven by changes in regulation, changes in compliance. But as Tom rightly pointed out, I mean, these are strange times, and we learned a lot of lessons after 2008 and the crash and tech, and that drove innovation. It's going to be no different this time around. So, you just got to be in an agile environment and be able to respond quickly, really.
And I think also, I mean, it does these times ultimately come down also, I mean, this is a bit of a sort of biased approach because we've done it, but we as a company have taken the ultimate decision that, yes, that a company must exist by revenue, but we're actually also taking the point of view of there is, even at the corporate level, a vast social responsibility to help. Okay, so what we've done is we've tried to enable our products to be able to use for smaller customers simply through plugging and playing and adoption at extremely low cost. But I think what we're going to hopefully see is the bigger players that can make a bigger change come around and have a social sort of stance to say, actually, we need to do this for the greater good as it was. So I think we're going to see a lot of companies come up with some very cool initiatives to help other firms. And ultimately, the more open infrastructure and sharing there is, the better things will be and the quicker they will turn around to be the positive. So I think we're especially looking at open infrastructure to enable people to plug into our system and utilize parts of our product that we design. We're seeing this in the UK with anyone who has a 3D printer. I have a friend who actually is heavily invested in looking at cold fusion. I mean, it's ridiculous, but he has about 1,000 printers across all his factories, and he's working with the NHS. So I think we're going to see these people pop up and say, actually, I've got a system that can, let's say, be adopted to help small businesses apply for their loans. Or I've got an algorithm that can show, are you going to be able to use, or have you been furloughed? Can you use this portal to see, are you eligible? So we're seeing some very cool stuff turn around in a matter of days, as we pointed out, Craig, that things are changing constantly. We're seeing companies, the big and the small, rise up to the challenge and openly say, we are doing this to help, which I'm very excited about. It's never happened in my lifetime. It's always been sort of capitalist driven of saying this is going to make us money. For the first time, I've seen our industry and tech providers turning around and saying, actually, we can help. So let's do it.
Yeah. So, do you think that that the open architecture is driving an expectation of increased change, or is our regulations driving open architecture and some of these methods to be more nimble, or is it just an accelerator between the two?
I think it's almost sort of like an arms race in the sense that regulation, yes, is making companies change. But I think from what we've seen, the pace of what we've seen change in the last 5 years, let alone the last 5 days, I think companies are taking the proactive approach, saying we need to push ourselves to share information, because the more that is shared, the more you can plug in, and the better your product will be and the better your services will be. So I think it's a bit of both around regulation, making it more open, but also tech companies and any company really turning around saying we need to be in this open infrastructure, because ultimately if we don't partake in it, we will be left behind.
Yeah, we can't respond as quickly as necessary. But let me turn it to the end. Just final thoughts, and Tom, you agreed to summarize some final thoughts. But what key point did you want to leave the audience with as we wrap up today's episode?
Yeah, I think the key point we wanted to finish with, and I think Ian will probably agree and chime in after me. I think although we are going through a very turbulent time, I think that the products out there are extremely useful for any corporate of any size. You are able to utilize open banking, or even in the US, go to your banks and say, have you the APIs? Because of what's driven globally in one region, it's affecting others. There's a domino effect. But I think that companies have made it extremely easy for corporates to utilize technology now. 18 months ago, we started seeing it, and over that period now, we're seeing enormous companies making it very easy, but also an enormous number of new companies popping up. So I think anyone who has any hesitation around change is now being forced to do it. And I think with what's going on, there are tech companies out there and technologies out there that companies can use to better position themselves in what is a very turbulent time.
Tom and Ian, thank you so much for joining me today on this episode of the Treasury Update podcast. Stay safe, and again, thank you for your words.
Thank you very much, Craig.
Thank you very much.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.